Hi there, it's Carol Schiffer with Coldwell Banker in Brentwood, and I wanted to talk to you about another aspect of qualifying for a loan. And this is going to be the conversation you're going to be having with your lender up front. But it carries itself all the way through. So one thing before I forget, and that is when you are buying something, and please remember this, and I know I will remind you, when you are buying a property and you have your loan approval, don't buy anything and put it on your credit cards. Don't lease a car, don't buy any appliances, don't buy any furniture, because guess what? The lender is going to run a credit check before they fund the loan. And if your credit rating has changed, guess what? You just lost your loan approval. And it's painful to see this happen, and it does happen, and people are very excited. Okay, honey, let's go out and buy that washing machine and dryer. Not so fast. So let's talk about ratios. The lender in qualifying you is going to look at all of your long-term expenses. Long-term expenses are 6 months or more. So that's credit card debt, including student loans, car loans, mortgage payments if you have other properties, car payments, anything that you would have that's going to impact the ratio of your debt to income. And that's critical to them, because at the end of the day, the banks really don't want to own that property. So they want to make sure that they are making a safe loan, because that's not their business. Their business is to make a loan, sell it off to one of the government agencies that buys the loan, but gives them more money to make the loan to the next guy. And that's what they want to do. So a few years ago, when we had all these problems with the loans, they weren't getting their monies, and that's when we had all these other issues. So the lender is going to look at your loan to debt ratio. I remember a few years ago, I was representing the seller, and I'll never forget this transaction. The buyers were both dentists. No, sorry. She was a dentist, but she was a part-time stay-at-home mom, and he was an ER doctor. They had leased cars, 2 very nice, expensive leased cars, and their ratios were off. And the bank kept coming back to them and trying to juggle everything to make sure that we could get those ratios where they needed to be. Guess what? And it was really stupid. The bank made them turn in both leased cars so they could get the ratios back to where they needed to be. That's all well and good, but how was he going to get to work without a car? So he turned the car in, she turned her car in, and when the escrow closed, they went out and leased these cars again. And I mean, that's how silly it can get, but also tells you how important it is to make sure that you clean up any debt and know what all your expenses are. So give me a call. We can talk about all this, and I look forward to hearing from you. Bye.